Every major collapse began during calm. That's not coincidence. That's the warning. Welcome to Wheelixon, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. For most people, financial collapse feels sudden. Markets crash, banks fail, confidence disappears. And the common question always follows, how did this happen so fast? Applied financial history gives a very uncomfortable answer. It didn't happen fast at all. Collapse almost always arrives after a long period of apparent stability, and that stability is not a sign of health. It is often a sign of exhaustion. Throughout history, the moments before collapse rarely feel dangerous. They feel calm, predictable, controlled. That is not accidental. Financial systems do not collapse when chaos is visible. They collapse when risk has been absorbed, hidden, and normalized for too long. Stability is one of the most misunderstood concepts in economics. People assume stability means safety. History shows the opposite. Stability often means that pressure is no longer being released. It is being stored. Consider ancient Rome. For decades before monetary collapse, the empire appeared stable. Trade functioned, taxes were collected, armies were paid. But beneath the surface, coinage was being debased. Silver content declined gradually. Prices adjusted slowly. Nothing dramatic happened. Until confidence vanished. And when it did, collapse followed quickly. This pattern repeats across centuries. The late Ottoman Empire, pre-revolutionary France, the Weimar Republic, the Great Depression, the 2008 financial crisis. In every case, the most dangerous period was not panic, it was calm. Why does this happen? Because stability changes behavior. When systems appear stable, risk tolerance increases, leverage grows, margins thin, warnings are dismissed, people stop asking hard questions. Applied financial history shows that long periods of stability create moral complacency. Institutions begin to believe that stability is permanent. Risk models assume yesterday will resemble tomorrow. Safeguards are loosened, not recklessly, rationally, because instability hasn't shown itself in years. This creates a feedback loop. Stability encourages risk. Risk deepens dependence on stability. Eventually, the system becomes fragile, not despite stability, but because of it. Another critical factor is risk migration. When visible risks are suppressed, they do not disappear. They move from markets to balance sheets, from private institutions to public ones, from short-term volatility to long-term fragility. This is why calm periods often coincide with record debt, record leverage, and record confidence. Nothing seems wrong. Everything seems optimized. That is precisely the danger. Before 2008, volatility was low. Interest rates were stable. Housing prices were rising steadily. Credit was abundant. This was called the Great Moderation. It was celebrated as progress. In reality, risk had been repackaged, not reduced. Stability also changes how warnings are received. During calm periods, warnings sound pessimistic. Those who raise concerns are labeled alarmists. Institutions that benefit from stability resist disruption. And so warnings are delayed, diluted, or ignored. Applied financial history shows that systems rarely collapse because no one saw the risk. They collapse because acting on the risk would have disrupted stability, and stability was valued more. Another overlooked factor is time horizon distortion. Stability shortens institutional memory. Decision-makers focus on recent performance. Long-term risks feel abstract. Future consequences are discounted. This is not ignorance, it is structural bias. As stability persists, the system adapts to it. Debt structures rely on low rates. Asset prices rely on constant liquidity. Governments rely on steady growth. Removing stability now would cause pain. So it is preserved, even if it becomes artificial. This is how systems drift into fragility, not by failing early, but by succeeding too long. Collapse occurs when one of three things happens. A shock exceeds stored tolerance. Confidence breaks suddenly, or intervention fails to restore calm. At that point, stability reverses violently. Importantly, collapse is rarely proportional. Years of calm can unravel in weeks, because stability masked the buildup. Applied financial history shows that collapse is not the opposite of stability. It is the result of prolonged stability without correction. This is why policy responses often appear late. Interventions that worked in the past are repeated. Liquidity is injected. Rates are adjusted. Confidence is reassured. Sometimes this delays collapse. Sometimes it accelerates it. When systems reach this stage, options narrow. Every action has consequences. Every delay increases cost. Stability becomes expensive. Another key insight, collapse does not require total failure. Partial failures can cascade. A bank fails. A market freezes. A currency weakens. Confidence spreads faster than facts. Stability evaporates. This explains why collapse feels emotional. Fear replaces trust. And trust cannot be printed. Applied financial history does not suggest that stability is bad. It suggests that unchecked stability is dangerous. Healthy systems release pressure periodically. They correct early. They tolerate small failures. Unhealthy systems suppress volatility. They avoid discomfort. They delay adjustment. They appear calm until they aren't. And so, understanding this pattern changes how you interpret economic calm. Low volatility is not reassurance. Record confidence is not proof. Long expansions are not guarantees. They are conditions that require scrutiny. This perspective also changes how you hear officials speak. When stability is emphasized repeatedly, ask why. When risks are described as contained, ask where they went. When calm is celebrated, ask what was postponed. Collapse is rarely a surprise in hindsight. The signs were present. They were simply muted by stability. This is why applied financial history focuses less on timing and more on structure. It does not ask, when will collapse happen? It asks, how much pressure is being stored? And that question matters far more, because collapse is not triggered by fear. It is triggered by the moment stability can no longer absorb reality. Every system eventually reaches that point, not because it is evil, but because it is human, built to preserve order, and order always resists correction. This is the final paradox. The more a system appears stable, the more carefully it should be examined, because stability is not safety. It is often the calm before adjustment. If you want to understand money beyond headlines, subscribe to Wheelixon.